Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Logan Allin, founder and managing partner of Fintech, a full life cycle global asset manager exclusively focused on fintech. Logan joins me to discuss Fintech's quarterly navigator report that provides a pulse on the current state of fintech and related sectors. Logan, it's great to have you with us. Welcome to Trade Talks.
Thank you, Jill, for having me.
All right, let's start with the macro here. How are macro forces impacting VC investment in fintech?
Well, it's a much different picture than when we put out that report as of this past weekend, which was certainly a stressful time for all of us, but it felt like the tech community came together. And obviously, we got a big boost from the Fed and the FDIC, who I do think made the right move in announcing on Sunday that they would backstop depositors. Certainly for us, we're keeping a close eye on March 22nd and the Fed meeting. We do believe the FOMC is going to increase rates by 25 basis points and continue on the tightening train. That will create more pressure, obviously, on growth equity in the public markets and in the private markets. And that is going to have a obviously headwind effect on 2023, which we think is going to be an acutely painful year. We already thought it was going to be a problematic year. And then with the SVB knock-on effects here to middle market banks, as well as the broader tech community, a massive void has been created. I mean, effectively, SVB was the heart of the innovation economy, and that void is going to need to be filled by either other tier one banks or other middle market banks and or tier one banks. Biggest headwinds, I think, going forward will be cost of capital. Certainly more conservatism by PE and VC investors on valuation multiples. And suddenly now you have lack of venture debt out there as well. And so the macro is looking fairly gloomy, unfortunately, for fintech. I think enterprise fintechs, B2B software, which is where we focus, will be more insulated, just given gross margins, capital efficiency, and the characteristics of those business models. But I think you're going to see a ton of pressure on those B2C, B2SMB, and crypto native models that have balance sheet risk, regulatory risk, credit risks, et cetera.
And if we take a look further out, of course, you can't fix what happened with SVB overnight, but do you think if other tier one banks and other players in the system, does it remove some of the concentration risk where it's not all at one bank or just a handful of institutions?
Well, I think there's going to be flight to quality to tier one banks. Certainly, there's concern around other middle market banks. They destabilized yesterday. Moody's came out this morning and obviously are going to consider ratings changes at those banks, and that's concerning. Equities overall are up, and those players like FRB and Western Alliance and so forth have recovered. But I do think this is actually going to create a flight to the tier one banks who are going to step in and create offerings like venture debt or capital call lines for GPs, which is historically what we've all needed in order to continue driving our businesses forward. It had not been provided by the tier one banks. And so I think they're going to step up. And unfortunately, this probably creates more systemic risk and more concentration of deposits at the tier ones and a flight out of the middle market banks. And we think that's an unfortunate consequence of what was poor risk management on SVB's part relative to hedging out their risks. And obviously inversion in the yield curve, creating some held to maturity issues in their balance sheet. And obviously that then being driven by further bank run issues and contagion. So, SVB played a significant role in the heart of Silicon Valley. They will absolutely be missed, but I do believe, certainly some of the relationships we worked with and other VCs and GPs work with at Silicon Valley Bank will persist in some form. We're not sure who's going to acquire the bank holding company vis-a-vis SVB Securities and the private bank and so forth. But I'm sure that will get announced in short order.
Focusing on the report specifically, where are late stage companies focusing their growth efforts?
So I would say on three things. One is efficient growth and looking to become EBITDA positive in either the immediate term or within 1 to 2 quarters, as many of those businesses look at going public. In case the broader markets didn't think that VCs knew what EBITDA was, we sure do now. And then number two, governance and risk management. So ensuring they're shoring up their boards, putting in risk controls, treasury controls, and so forth, as they do look at entering the public markets. That includes SOX and audit readiness and so forth. And then third, a significant amount of outbound M&A opportunities. Believe that all the late stage privates, and this will apply to a number of the public equity investors in fintech as well, believe that it is a time to play offense on M&A. And there'll be some opportunity to consolidate bolt-on product offerings and so forth. And so it's quite an attractive environment for them in shoring up their product set, their distribution channels, maybe their internationalization and so forth before they do go public.
How is London overtaking San Francisco and New York City in fintech funding?
Really excited to have a London office in the Mayfair. We opened that office in January of last year, and it has been a tremendous hub for fintech. Amazingly, in 2022, venture funding in London for fintech was 9.5 billion. In New York and San Francisco, that number was close to 7.5. So $2 billion spread in London, and that's exciting for that market. I believe that UK government and regulators, frankly, have just done a stronger job for fintech vis-a-vis open banking rules, sandboxes, and providing space for fintechs to innovate. And then, obviously, with Prime Minister Sunak announcing recently the 440 million, almost $500 million that he and the UK government are going to put into STEM, and they want to be a STEM superpower by 2030. They also stepped up, obviously, with the SVB UK issue and brought in HSBC very swiftly to acquire that business for £1 plus 2 billion pounds of liabilities, although the £1 was all that was reported on. And so we think that's exciting for London. And in spite of Brexit, they're still thriving, albeit they're going to have to figure out regulatory passporting and how those UK companies end up transforming their growth in terms of entering the EU and cross-border into the US. We also think they're going to have to address growth equity and their IPO and exit opportunities because those have been very minor historically. In addition, there's 27 tech unicorns in London today. And there's been 168 spin-outs in 2022, and we're seeing that persisting. So the rate of new tech company formation is an all-time high, and that's exciting for the region and certainly will bolster new funding opportunities going forward.
And I know it's a kind of a tough week to be asking this question, but where do you think the transformational opportunities in the fintech space are, removing what happened with SVB and, of course, removing the challenges of the macro environments?
Absolutely. So we continue to believe that B2B software within fintech is the most constructive location to be investing and certainly presents a transformational opportunity in terms of companies that are selling into banks, asset and wealth managers, insurers, fintechs, and corporates. And corporates today, that's big tech like Apple, Amazon, and Google, along with retailers like Walmart, who has obviously been very public about their fintech initiatives. So those 5 end customers are absolutely looking for fintech software. And we believe there's going to be, a silver lining here in terms of SVB's fallout as it relates to fintechs that are trying to solve for those issues. In other words, diversifying bank balance sheets and helping them get access to other loans. And/or creating treasury management, risk management solutions, money market account access, et cetera, in a much more efficient way so that risk is more mitigated on a go-forward basis. So my hope is that Silicon Valley and others do what they do best and innovate in the face of significant challenges.
Right. And Logan, let's talk about another silver lining here. We saw the valuation reset, not just the private markets, but the public markets have taken over the past 12 to 18 months. Do you think perhaps that could be a good thing, that we're focusing on profitability, the path forward, not simply valuations that are assigned and how many unicorns are out there, but then, also focusing on developing corporate management teams, for focusing on governance and a strong board for leadership? These things kind of needed to happen.
Absolutely. It's a return to fundamentals, and we're excited by that. And that applies from both seed all the way to public equities. Multiples have compressed and come back down to reality, and there's clarity that you cannot be negative on a contribution margin basis and still persist in the public markets as a cash burner. You look at all the indexes for cash burning businesses, and they're down 90+% since January of last year. And we think that has created a focus from private to private companies, as I mentioned, on being EBITDA positive, having strong gross margin profiles, having real board governance, and so forth, that's going to make them a sustainable, durable, more long-term business. And that's a positive thing. Now, for the VCs, I hope it's reset the view that you need to be focused on DPI for your LP base and driving returns, because TVPI and having a good markup on an unrealized basis isn't that interesting. And pensions, endowments, and foundations aren't able to eat that, so to speak, in terms of getting access to liquidity, and that's creating a real denominator effect in those LP bases. And so I think a renewed focus on thoughtful portfolio construction, driving exits and liquidity, and pacing over the course of 2 to 3 years versus deploying a fund in 6 months and then going back to market. I think that's also created different behaviors in the venture market as well, and that's a net positive.
Right. Excellent insight, Logan. We appreciate it. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.